This is Investment Community with me, Justin Newdigate, in conversation with the most insightful players in the financial market ecosystem. My special guest today is Dave Foord. Dave is CIO of Foord Asset Management, a firm that he founded way back in 1981. He began his investment career in the late 1970s with a 3-year stint as an industrial analyst at Old Mutual. Dave is a student of economic history, and apparently he's pretty good at sailing and bridge. This is the first of 2 episodes of our wide-ranging conversation. Dave Foord, welcome to the Investment Community Podcast.
My pleasure to be here.
So Dave, you've been in the industry for 40 plus years. What have been some of the highlights of your long career?
Sure. Highlight, I suppose, is surviving for 40 years. Not many people have.
No.
It's been a pleasure to look after the small guy. And the pleasure is just recently we get emails or compliments from people that have been with us for 40 years. The firm's 40 years old, so we sent out some marketing guff on the 40 years, and we're getting messages from people that say, I remember when we went to you offices in Green Market Square in 1981, and what a fantastic time it's been, and we really appreciate that you've looked after us for 40 years. And that's the good part. It's really pleasing, and there's a lot of appreciation from the small guys. And I suppose it's made even more important by the contrast you get from people in the industry and the gatekeepers and the consultants who are always criticizing and blaming and but never a nice word to say. But the highlight for me is the appreciation from the people whose pension we've looked after and who are able to retire comfortably, far better than they have in a lot of other places. The pensions from some of the companies that we've got that have the unusual ones, which have stayed for us the whole duration, are getting pensions 65% higher than the standard pension.
Wow.
And that's the highlight for me. That's the real pleasure of the game. And the raison d'etre, what we're really trying to do is beat inflation and provide a retirement income for people.
That is truly something to be seriously proud of. If you had to drill down from that kind of macro meta area of that you've just been speaking about into some specifics, perhaps times in the market or times as a business, any particular highlights that stand out for you?
Well, I just relate myself to being very lucky. Starting very early in the industry, in a nascent industry, which was underdeveloped, and sort of rode the tide with it. So lucky from that starting point. I was also very lucky to get the position at Old Mutual as an industrial analyst at a time when they were expanding, and if they weren't looking for 5 analysts and 2 industrial analysts, I probably wouldn't have made it. I think I was the second choice as the industrial analyst out of 2. So lucky to get that. And then very importantly there at Old Mutual, Tony Fernie was a man ahead of his time and really went out of his way to educate us about investments in the new order. He had been to Wells Fargo, which had a supposedly new method of investing. And we had a great mentorship there from Tony Fernie. And so really appreciate that. Learned a lot from him, and the passing on of information that we had there, we had to present our thesis. Every week there was somebody presenting on something and we all attended. So we weren't just learning what we were learning, we were learning what everybody else was learning. and it was a great environment to be. And there were some big successes in the South African investment industry that came out of that team that Tony Fernie put together. And I was lucky to be one of them. So very blessed on that. And then we grew with the industry. It was very difficult to break into institutional. In the early days, they wanted a 3-year track record. And of course, when you get a 3-year track record, they want a 5-year track record. And when you get a 5-year track record, that's still not good enough. There's still some other reasons. So you get used to the excuses that are there in the industry, and you have to be robust, and you have to have a very thick skin and understand that there's other motivations for people investing with you. But we were lucky to break through into the institutional market, and then we spent a period. We were Johnny on the spot. We were getting the performance, and we only wanted to, from the day one, we only wanted to manage money and not people. And size is a problem in this industry. If you get too big, it's difficult to perform and get the numbers. So we would try to make sure we look after our investors by not becoming too big. And there have been 3 phases where it's been quite difficult to do that and turn down money. In the 90s, we were turning down money. And because we were turning down money, the gatekeepers turned on us and said, well, if you're not going to manage for us, then we're not going to give you the business. We're going to take away business, things like that. But we still think that was the right thing to do. And the firm stayed doing the same thing for those 40 years, intent on doing the right thing for the investor, not trying to gather assets.
It's often spoken about. There's lots of lip service given to that. It's seldom practiced, and the tension between investment returns and business success. Generally, the business success triumphs. What enabled you, Dave, to keep the focus on investment returns and not be sucked into trying to gather assets and grow the business fast?
Can't put it down to any one thing other than it was the right thing to be doing, because I suppose ego-driven, trying to get the right results for our investors, rather than bragging about size of assets. Also understanding that size of assets would come anyway with the performance. Always said in the early days that the bees will find the honey. We just got to put the score on the board. But we went through 3 phases where we were turning down money in different ways, and the 90s was one of them. We were growing too fast. So it's partly a phase of growth and partly, but also there was always that balance. You need to be a little bit bigger because you wanted to afford more resources. Right. So you've got to get that balance right as well. And I think we've done that over those 40 years. We've been able to have the right resources without impinging too much on size. And the size constraint also is something that you changes. Nothing stationary in the world, nothing stationary in the investment game. And in a bull market, any size is too big because you can't get hold of assets. And in a bear market, you've got plenty of choice. Right. And it's in the bear market that you need to be accumulating. You don't want to be taking on clients at the peak of a market. You do want to be taking on clients at the bottom of a market. But funny enough, they don't understand that. Nope. And so that becomes an issue that you need to manage. So it's a lot of things like that. I think that managing the business, managing the people. I always wanted to manage money and not people. And that helped us on the size thing. I knew that more assets means more people, means more dislocation. Investment people tend to be prima donnas. And so you get too many of them together, it's a recipe for chaos.
So let's backtrack just a second to a time when you co-founded your original firm, Foord and Meintjes. 1981, you just spent 3 years as an industrial analyst at Old Mutual. What gave you the confidence to step out on your own so soon, Dave?
From a very young age, I understood that I'd be an entrepreneur. Not that I used that word then because I didn't know what it meant. I always thought I'd be a widget maker, a manufacturer. And so in articles, learning about businesses was great. And at Old Mutual, learning about businesses was great. And even at that late stage, I envisaged myself starting off on a factory. which is a crazy thing to do because all the problems of factories. You're in the wrong end of the economic chain as a manufacturer. It's the distribution side that makes the money. One day, had this epiphany chatting to Mainchees. We played bridge together, and I said, actually, we should start in this industry because people are not getting good advice. The banks are telling people to take fixed deposits. The insurance companies are selling life policies as investments. And the building societies want the money against mortgages. The stockbrokers are churning portfolios. So there's actually an opportunity here in this industry because it's not being done correctly. You need to take a longer term view and look after people and manage their money the right way. And there's a need here. And so we started. And Mainchees liked the idea. He had a shorter time horizon on it. I was career long term. He said, I'll give it a go for 5 years and see how we do. And he did the marketing side, and I was the backroom boy. I'm not the guy who likes to do the FaceTime. Very shy and introverted. And lucky that he wanted to do it, and he did it, and he got out there. And as an actuary, incredibly bright, one of the brightest persons I've ever met. And a pleasure to start business with him. It was great.
What surprised you in your firm's early years?
How difficult it was to communicate and get the institutional business in. But, back in those days, we were starting with minimum size account was 20,000 Rand or $20,000, and we could make a living if we had enough. If we managed to get 5 million Rand under management, we worked out that we could have a business.
So we spoke a second ago about the difficulties of breaking into the institutional market. It sounded like the gatekeepers were not necessarily open to your and Liston's story. How did you navigate those obstacles?
Liston did it, so full credit to him, by communicating. But we did it by showing the performance numbers, and the performance numbers were just outstanding relative to the others. And once we got onto the scoreboard where we were lucky enough to get an account or two, and those numbers then became visible to other trustees, and the gatekeepers were sort of forced to take notice because our score was on the board and other people were talking about it. And then it spread from there, and Liston was doing the communication on it. And and fortunately for us, the performance held even when the new money came in. And it's all about performance. You've got in this game, it's a Darwinian system, and you're as good as your last score.
Yeah.
So the visibility of the score helped us, and obviously the score helped. And a few people were prepared to try us, which we eternally grateful for. But it wasn't all plain sailing. The pressure that you're under when you're underperforming, like into the 98, 99 period, that was immense. And I'll get onto a story on that just now. One of the low-light things what happened to us was we had a non-pension client who had money with us for a benevolent fund. After 10 years, we had 8.5% per annum alpha on the straight equity fund.
Crikey.
And at 5 minutes to 2 on a Friday, we were fired because there was a new consultant on the fund, and he decided that he needed to make a change and didn't want the money with Foord. And that at that stage was quite a lot of money for us. It was a couple of 100 million Rand. And so the money left on a Monday. And then the other thing that happened to us is we would get some pension fund business, and the pension trustees would invest with us their private money. And then later the fund would leave us, but the pension trustees would keep their money with us. To the extent that even 10, 20 years after the fund left us, that trustee was with us. But once it goes, it doesn't come back, the trustee, the corporate money. So the individual stayed with us, but they didn't. And the fact is that senior executives from all the three major life offices had private money with us. Right at the beginning, Liston and I were aware that direct investment would be better than a retirement annuity business, despite the tax advantage up front. Because you're paying tax at the end, you're actually better off paying the tax, putting the money into a unit trust. So we tried to get a unit trust license, and we were rebuked for no reason given. We then tried to buy, if you remember the history, 1969 crash, a lot of the unit trusts didn't have enough liquidity, and the life officers were called in to help, and Sanlam ended up with a whole lot of mutual funds, which they weren't really using because they were selling life products. So we approached Sanlam through Liston's connections on the actuarial side, and we wanted to buy 2 of their funds, making a Reg 28 fund and for pensions and an equity fund. Management agreed to sell 2 of their funds to us. It went to the board, and the board said, no, what the hell are you thinking? Don't help the opposition. As it transpired, we wouldn't have been able to transfer the funds to us. We would have had to come to an agreement with them because the FSB wouldn't have allowed us to take the license. There was an unwritten procedure within the Financial Services Board that mutual funds needed to be owned by a bank because of the liquidity issue. So we carried on trying to apply and get a mutual fund license for about 15, 16 years, and were rebuked. Even after South Africa opened up and we were allowed to invest offshore, we could get a mutual fund license offshore, but we couldn't get one in SA. We could get in a relationship. We were strong enough to be recognized in the market, and we could get participation with a bank, but all the banks wanted 51%, and we weren't prepared to do it. So that was a no-go. And then eventually we found a bank which would give us 75, and the bank took 25. It was a small bank. And we got a license, and 3 months later, anybody could get a license. And so now we have this number of mutual funds that we have in South Africa now. So yeah, those are the sort of travails and the hardships that you have to go through. So we've been able to get those 2 funds 20 years earlier would have made a huge difference. But I think what's also important to know in the history that when we went offshore, we were allowed to take 15% of the retirement funds offshore. We didn't sell that to the international trading banks like a lot of people did. And it was a disaster for the industry, by the way, because it was just before the Asian crisis. And a lot of the modern money went into Asia, and there's stories about some people losing 55% on the pound. We decided we didn't trust the American trading banks or the British trading banks. We'd rather manage that money ourselves, a little bit arrogant to do so. But we did hire Bruce Ackerman, who'd been at Lloyd's managing international funds. And so, you know, we got a license. So the Foord International Trust was started on the basis of that, and we looked after our investors' money ourselves. And so we avoided that debacle that everybody else had. And into that dot-com era, we had died data and shares like that in SA, and we were seen as idiots because we didn't understand that. And the consultants and gatekeepers were taking money away from us in that period. And what a lot of people don't know is that, you know, after spending 10 years of pushing money away, suddenly you're getting money leaving. You now need to manage that. But we lost 75% of our assets under management in 7 months. In that period, but then it turned and we were proved correct, and the money started flowing back, but not from the same people. It comes from different people. They're not going to admit they made a mistake by taking the money away. And yeah, then we started to grow again. It wasn't 3 years before we started to, you know, make it more difficult to take on large amounts of money, and so we were very, very lucky. A lot of ways we've been very lucky on timing. And different things could have happened different ways. But we've also been very conservative in managing the business, and always been in a position where we know the market can halve and half the clients can leave. So we make sure that we're not spending all the money on growth or spending all the money on whatever. So we've always had a huge margin of safety in terms of our own cash flow. and make sure right from the start we had cash flow to cover the next 18 months. And then it became 3 years. So we always had cash in the bank to pay for expenses for the next 3 years. The sort of thing that you need to do when you're managing a business like this.
Yeah, and you know that halving your assets is not a hypothetical. You've felt it.
Yeah.
So, Dave, as your firm has grown and evolved into the Foord Asset Management we know and love today, you personally will have also grown and evolved. And in what ways would you say, Dave, that you're different to the younger self who started out all that time ago, 40 years ago?
I am enormously different because I'm learning all the time. I'm still learning. This is a wonderful industry. It's a fantastic place to be. I tap dance to work every morning. I can't wait to find out what the latest news is. It's a struggle. It's a challenge. It's a beautiful industry to be in. Take out the gatekeepers and the people. The markets are evolving. It's all about economics and politics and all the different things and behaviors, science. It's fascinating. When I started, I knew 1% of what I know now. And I still don't know enough. I grow older every day, learning more and more about what I don't know.
So you're talking about accumulating knowledge, which is a wonderful thing. I'm also wondering, what would you have had to let go of to enable and allow for the growing and maturing?
Simplicity has always been the watchword. It's in this game, the brightest people don't do well. It's the simple folk like me that do better. There's price and there's value. And value means different things to different people, but the price is the price. Right in the early days, we were not, but Liston and I were very much against the efficient market hypothesis and realized, and the whole industry went that way, and the ivory towers in the States pushed that theme. And it's a very simple thing for us to understand that the market is not efficient. And more that inefficiency is there for the same reason. But the price is being determined by the latest trade, and the latest trade is by people who've got a short time horizon and not interested in the value of the business. And it was similar in those days. By definition, the price cannot be the true value. So there's your opportunity in the market, is to determine the true value and be patient and wait. Always wanted to be more like Philip Fisher and buy and hold. Once you found a great business, you want to hold it and compound it. That's important. So the two times to sell something is when you shouldn't have bought it in the first place, or when you find something better to buy. That we've always adhered to. But understanding that value is a future earning stream at a good price. That's the value for us. So we went through a long period of being put in a box, because the style and what the industry wants to do. In terms of what we are, we're successful investors, not value investors. We are value investors because we like to buy value. But our definition of value is a future earning stream at a good price.
Let's pick up on that, because I've heard you describe your investment approach as empirical pragmatism. What does that mean, Dave?
That's something that somebody mentioned, sounded like us, and I said, yeah, that does work. So empirical is all about the evidence. Look at the evidence, look at the facts. And pragmatism is you've got to be practical. You've got to be realistic. That's what I mean by that.
Right. So that to me connects to the earlier question about what you might have needed to have let go of, or never taken a hold of. When you say you like to keep things simple, it sounds to me what you're doing there is you're saying no to a lot of things. You're saying no to things that are not empirically pragmatic. You're saying no to stories. You're saying yes to facts. Perhaps that's something that you're continually doing, it seems to me, saying no to stuff, no to fads.
We're saying no to a whole lot of ways that people invest in the world. We're saying no to a whole lot of things. You're saying no to the sell side. Yeah, I think that's an important involvement. In the early days, because we were a short team, and the sell side was spending a lot of money on it, and the brokerage was still quite high, so you needed to get value for that. But very early on, we started to hire our own analysts because we wanted to get away from dependence on the sell side, and a big cash flow issue for us because we would be spending the money on the analysts. But that was an important decision that we made early, was to have our own analysts and have our own opinions rather than go by the sell side's work. And economically, it wasn't a great decision, but it was the right thing for our investors. And it's part of what produced the results. You still wanted to look at the sell side and see what they were doing, but that was to help understand why the price was where it was, not because you were going to follow the sell side. So yes, letting go of the way other people do it, finding your own way, right from the early stages, as I said earlier on, efficient market hypothesis and a whole lot of other beliefs. We just don't believe in them. But you do need to understand the difference between speculation and investing. Very few people do that. It's been covered by Graham, etc. But that's one of the most important parts of the Graham book is understanding that you're making an investment in the state. That means you need a long time horizon, whereas speculation is just trading. The proliferation of hedge funds is trading.
So it seems then that you're navigating this tension between being fiercely self-determined, but in the context of an environment that's in flux all the time. That everything's changing, all the moving parts are changing. So how do you marry those two, or how do you find an intersection between those two almost competing imperatives?
Well, the change is the one constant, and that's also the opportunity. We risk and opportunity, go together. One of the things we worked out after about 10 years is that we actually not just managing money, we're actually managing risk. In order to finish first you must finish. And so don't bet the farm, because there's always some flood that comes along. And it's funny how the 50-year flood comes around every 5 years. So one of the big things we need to learn is you need to survive, and that goes back into that thing of having some cash. And it's part of the book. Very few people pick it up in the Intelligent Investor, and it's loud and clear because that's what Buffett does with his float. He's always got a lot of cash, so he doesn't have to sell at the top because he's always got cash at the bottom, and he carries on buying into that. So cash is not there for cash's return. Cash is there for the opportunity side. And you must always be in a position that you've got cash when other people don't have cash. Right. I mean, we had an incident like that. We had a very bright guy work for us on the derivative side, and we got a derivatives mandate from the PIC, and we had this extra cash, and so he decided to put the cash into very safe short-term instruments. Then there was a crash, and he couldn't sell the short-term instruments to cover his margin call. I had to come in and sort that out and take a haircut on those and put my own money at risk to get that account solvent again. And I did that. And no sooner had we done that than the PIC decided that the money should go somewhere else.
Thank you very much.
Yeah.
So that's such a fascinating thing that my understanding of that carrying cash is you're creating optionality, strategic optionality in your portfolio.
Yeah.
Liquidity that you can deploy in a crisis that isn't near cash, but is actual cash. So having prepared yourself in a kind of a physical, financial sense, how do you prepare yourselves, Dave, psychologically, so that you can exercise that optionality? You know better than I do that when you got to pull the trigger in the midst of a crisis, what you really want to do is vomit on your desk. So it's all very well having the cash. You've actually got to pull the trigger. That's no simple matter. How do you prepare yourself so that you might be able to do that?
By not going 0-1.
Yeah.
By not firing all your bullets, always keeping some powder dry. By diversifying. One of the free lunches there is in investing, and the main one is diversification. Now, diversification does mean you're not optimal, because you're not going to get the maximum score, because you're not going to be in the leading horse every time. But it doesn't mean that you survive. But you need to diversify correctly. So very early on, we worked out that there's factors involved. So in the 80s, we were already into factors. And you need to diversify those factors. What are the main factors which are going to, is it private consumption expenditure, is it the rand or whatever? So if you're going to have something which is going to benefit from a rand strengthening or something that benefits from a rand weakening, you must have something of the opposite as well. You need to balance the portfolio that way. And it's quite complex. But it was pretty novel in those days, and we didn't talk about it because we felt it was a proprietary issue. It's always darkest before dawn. I suppose discipline is the wrong word. It's almost into blind faith to know that you must buy. And I recall there was a quote from about the 1932 bottom. One guy was saying, well, how do we know that this is going to end well? And the answer was, well, it has always turned. But the corollary for that is you need to understand is that the bottom is always 10% away. And it doesn't matter when you start, it's going to be more than 10% away because, it always does fall further than you expect. I think what helps us, and I think is an important part of the history, you need to understand is that the very successful investors tend to be good at gambling. And my history is that I've been reasonably successful at gambling. So my first car I bought, I did genuinely come from nothing. My first car I bought from poker winnings. I bought my first house from horse race winnings. And I bought my first boat from stock market winnings. To understand the maths in gambling, you need to understand risk, and you also need to understand reward. You need to understand asymmetry. But most importantly, you need to understand probabilities. So it's all about the probabilities. And understanding the probabilities gives you the confidence to buy when all about you are selling.
And we as humans have a very poor grasp of probabilities as a general proposition.
Correct. That's an unusual skill and a very important skill to have in investment.
And I guess that makes for different kind of asymmetries. That's behavioral asymmetries that come about as a consequence of that misunderstanding of probabilities.
Correct. And the other thing that people don't understand is time. And that's why that little book we put out, it's called Time. And people don't understand time. Majority of people, Friday is forever away because that's when they're going to get paid as a wage earner, etc. And people don't understand time naturally. And I also noticed as I get older, the time is not linear. It goes faster every year. But time is the most important element of the compounding formula. It's another reason why people don't understand compounding, is they don't understand time.
So these are conversationally easy topics you're bringing up. The distinction between managing money and managing risk, the understanding of time. These are almost superficial in a way, and yet they're so deeply abstract that I wonder to what extent you're successful in communicating to your audience. Do they grasp what you're talking about?
No, I've never even bothered to talk about the subject this way. Because in the early days, if I talk about gambling, I'd say, well, we don't want to give our money to a gambler, et cetera, et cetera. So rightly or wrongly, and it's part of the thing, I've never been a good communicator. I've never wanted to communicate. I've always been quite insular. So these things I haven't communicated in the past, no. Happy to do so now.
Well, I think the investment community is incredibly privileged to be hearing these things from you, Dave. I know I am. I think there's always a problem, isn't there, with communication? We're told it's that important, and of course it is. But there is a point at which, when you're communicating as an investor with an edge, that you can over-communicate and you can give away your edge too cheaply, and that's not smart. That doesn't serve anybody's interests other than your competitors.
I felt that all along, which is why the gatekeepers and all that have found me very a difficult person and not user-friendly, because I don't want to give away my edge.
We're talking about preparing psychologically to be able to pull the trigger in a crisis. What other temperamental attributes do you feel are required by the members of your firm to invest the way that you do?
Conviction. You've got to have a belief in your conviction. You've got to believe in your facts. Successful investors do have that conviction, whether the conviction is soundly based or not. The market will sort that out in time. The market is very unforgiving to bad things. But what I impress upon my people is that whatever you're doing, there are assumptions. And you need to go over those assumptions very carefully. And in this day and age with spreadsheets, I mean, the easiest thing to do is create a spreadsheet which makes a stock a buy. But it's the assumptions, man.
Yeah.
Analyze the assumptions. Do you really believe every assumption? And put a probability weighting on all those assumptions. And then add them up and then come back to me and say, do you still really believe? So you've got to dissect the conviction and go to the root of the conviction, which is the assumptions, and bear those assumptions out, and then stress test those assumptions.
In the process of stress testing those convictions, is that something that you would tend to do as in a collegiate form? How would you typically do that?
The firm is very collegiate, so there's very flat structure, no hierarchies. Each individual needs to manage themselves, manage their own time, manage their own convictions, manage their own assumptions. But then that also comes with an openness that everybody can see and discuss what they're doing. There's no keeping secrets. And if somebody's got an assumption which others don't agree with, then that can be tested and discussed. So very much collegiate discussion on the points, and especially the assumptions being made.
That seems to relate quite tightly to your firm's adoption of the multi-counselor approach. Could you say how that originally came about, Dave, and how it's evolved over time?
Well, I got it from reading the book Capital, and Capital use it. So it's not something that we came across. And other members of our community who shall not be named also use it. It's not just our own invention.
Right.
I think it's fantastic because, again, it plays into diversification. Diversification is very important. It also plays into conviction. So as more and more members of the team are convinced about the merits of a particular stock or a particular position, then so the weighting goes up. But right early on, it was very clear to us back in the early 80s that the failure of other institutions, particularly the life offices, in investing money was that you run by committee, and by the time the committee meets, the opportunity is lessened. And the opportunity may not just be on price, but it can be on volume as well, don't forget. But also by the time the committee meets, if it's a great idea, it'll be a new idea. Therefore, 75% of the committee won't be up to speed with it. So you'll have to wait for another committee meeting. And then by the time you get more than 50% of the committee behind the idea, the opportunity is gone.
Yeah.
So the important part of the multi-counselor system is that the portfolio manager has got absolute rights, decision control, power to implement. So the portfolio manager can buy straight away. He doesn't have to wait for a committee. So that's the important part of that multi-counselor system, that it allows people to implement straight away. And to the point that, if we get an idea, I've got no problem buying the idea now and then researching it for 3 weeks. And then if we don't like it, sell it. So the time to implementation that the multi-counselor system helps, and it gives the diversification. Those are the key elements on it. I find it very, very useful, but there are other elements to it as well. So dependence on one person, and the star system, all those other things that are wrong with the industry.
Yeah,
I think really great. And no surprise, all the gatekeepers hate it and don't like it.
It seems a very consistent story, Dave. You love it, the gatekeepers hate it.
Sure, but the gatekeepers have got themselves to justify their existence, and they've got themselves to live with on their decisions. Right. It's not an easy job they've got. They are, just as we are managing money by allocating money to other capital allocators in the businesses, so they are articulated even further away from those businesses. So it becomes harder, and I understand that. Important thing to note as well, which we haven't covered, is that we've always seen ourselves as investment people, not share people. And the gatekeepers, again, and a whole lot of others, make decisions on investment managers as though they share people. And even style and things like that goes into style on equities. And equities is only one asset class. So we've always looked at equities as one asset class, and it's the asset class that's likely to produce the best returns, but it's also the asset class likely to give the highest volatility. And volatility is not risk in our minds. Risk is the potential to lose money or the probability of losing money, not volatility. It's the most absurd thing that's happened in this industry is to equate volatility to risk. It's an absolute obvious nonsense. We look at asset classes, and so one of the keys from early on, and we still do now, is interest rates. We're forward-looking, and we need to understand there is a business cycle, despite the fact that the Fed's trying to flatten the earth. And interest rates are key to capital pricing. And it's quite interesting. I've had debates and long conversations with very successful investment people who, look at the stats and the correlations and say that it's not there on interest rates. But very clearly, interest rates have a very important play in the capital rate, and therefore bonds, property, and also into equities. So you get the interest rate cycle right, you get both the momentum right, and then you also get the level right. It will help you understand valuations. So we've long been of the view you need to get the interest rate cycle right. And then once you get the interest rate cycle right, you can then have a forward look at what the risk-free return is. And then you bring that back to whatever asset class you're talking about. And try and get that, and then the selection is the next level. So we've long been of the view that when you look at the difference of returns, 80% is asset allocation or timing, and only 20% is selection. And yet the gatekeepers are all looking at either the past history of the score, which is fair enough, or they're just looking at style, which is actually only representing 20% of the main difference between what's causing returns. That's important to us, is to have a broad, and you're wasting your time if you're trying to do things to decimal places, but you need a broad brushstroke of what the economic environment is going to be like going forward. And that'll help you to understand what sort of returns you can achieve, what you should achieve, and where to allocate capital.
Across your multiple counselors, you would be presumably working off the same or similar set of macro assumptions, your forward-looking rates and so forth.
Correct.
Yeah.
But they are just outlines, and they have bands because individual line is no good.
Yeah.
So there are bands, and when the actual item crosses that band, then we redo all the economic variables from scratch again.
The whole multi-counselor thing I'm really intrigued by, and I see how also potentially you're diversifying at so many levels, and you're diversifying by portfolio manager. And I wonder if you were to deepen the diversification by having portfolio managers with different worldviews managing a single pool of capital, that becomes a very deep level of diversification. To what extent are your portfolio managers, do they have different worldviews, do you feel, Dave?
More and more they do, and they're allowed to have, and it's important that they do have, otherwise you don't get the benefit of the diversification. Sometimes the multi-counselor system doesn't work because people start to follow, rightly or wrongly, they start to follow the current successful owl. So you need the people in the multi-counselor system to be really independent, and not start to follow each other. And in part of what you also need to understand is there's no point having a manager with too small a weight. Otherwise, your success is not going to be there. And you don't want somebody to have too big a weight, because if he does fall over there. So you need a balance of that weight.
Yeah.
And the other thing is that one shouldn't change the weights that often. because you get back into the gatekeeper issue. You actually want to be upweighting a guy who's underperforming and downweighting a guy who's outperforming.
Right.
Which is not an easy thing to do.
And I guess, again, I'm sensitive to the fact that this could be proprietary, but the reward structure would need to be, I would imagine, an underpin to the structure working well, this multi-counselor structure working well.
Yes and no. The reward structures in the industry and all the way through to corporates in companies, the people have been paid too much for too long. And it's changing. It's very interesting to hear the guy from Schroeder saying that it's changing with immediate effect, that portfolio managers are no longer as important as they used to be. You're not going to get a smaller share of the pie. So that was a above trend. So we're getting some reversion in that area. Sort of managers we've got are not the ones greedy for their own take. They were the ones who are greedy for success. And the success is far more important than the immediate take-home pay. So if you find a portfolio manager who's avaricious, you probably shouldn't be hiring him. And that's the key. And you want people who are going to be taking a long-term view and not trying to fatten their own back pocket in the short term. The ones who understand how much is enough and enjoy the game for the game's sake are far more important to me.
We're talking a lot about cultural things here without giving it the headline of culture. It's difficult to measure, but important factor. So at a high level, how would you describe your firm's culture?
Aspiring to be successful, collegiate, learning, understanding that we need to learn a lot more because there's a lot more to learn.
I was going to ask you, how is that different to other firms? But I think you've made that question utterly redundant. So how is culture complicated or enhanced, for that matter, by your firm being located in different continents and you being in Singapore in particular?
It doesn't at all. I've been non-present. I've learned to work from home that the world has learned about in the last 2 years. I started that 20 years ago. So I was working from the boat, and the further I was from the office, the better the office performed. And better I performed because there's less time wasted with staff, time wasted with regulators, more time to think. If I wasn't on the boat, I'd be up the hill in a hut somewhere on my own, thinking, time to think. It's benefited. Singapore's got its own little thing. We've been able to access one-on-one meetings with international companies in Singapore that we would never get in London or anywhere else in the world, because Temasek's got investments in these companies, and those executives go to Temasek, and whilst they're there, they've got some spare time, so the broker brings them around to Foord Asset Management. We get one-on-one meetings with top S&P 100 companies, so that's a surprise. But the dislocation of meetings, we meet every day by Zoom, both offices together, all the investment people. That thing I learned from Fernie, that if people got an idea, everybody must hear it. So an hour every day, it doesn't matter where I'm in the world, both offices are meeting and discussing world events and stocks. So technology has allowed us to do that. And we've been doing it for 20 years, and a lot of other people are starting to do it now.
And I guess it also adds to that level of diversification. You're getting different cultures involved in the investment process.
And that's part of the selection of the individuals as well. You don't want people from the same background, same education. You actually want different people. You want people that think differently, have different backgrounds. And that's what we've got. You can see we've got a diaspora.
And that hiring story, Dave, I mean, that's not an easy nut to crack. What have you learned by hiring over the years?
Again, it's one of those things that's so important. You spend a lot of time on and more aware about how everybody else gets it wrong than claiming that we get it right. But yeah, you've got to be very careful on that. But it's collegiate again, so everybody's got to agree. All the key people have got to agree. We do psychometric testing, which a lot of people don't necessarily believe in, because you can change whatever, but it does throw out certain personalities. And yeah, so you filter bad behavioral types out. But you also get a lot of input from their peers, and the weighting that you put on that is very important. More so than with a stock. If there's any doubt, the answer is no. If there's any hesitation, no. So we've learned to be a lot stricter than we were in the early days. And therefore, we've made less mistakes, I think, than we did in the early days. So we've got very low staff turnover. The majority of people that have left us in the last 10 years have left to retire because they've either been paid enough and they've learned that they don't need any more. So I joke about it, that they leave and leave me to carry on working for their pension. But it's very satisfying that they've also learned that enough's enough, and how much is enough, and they've got enough, and they've been paid enough while at Foord, and they've learned enough at Foord, and they've left to retire and manage their own money, or leave their money with Foord to pay their pension for them.
What are the likelihoods that you could fall into the trap of hiring people that you like, that you could skew to people like yourself, or that you would like to spend time with, who aren't necessarily going to be additive to your investment process?
I certainly haven't been making that mistake. I'm concerned that some of my people do that, and that needs to be managed. But it's very easy to be clinical, and again, go back to the empirical side and stick with the facts.
Yeah.
We don't. I'm probably naturally averse to it, because I don't. If everybody's thinking the same, then nobody's thinking. So I don't want to be hiring somebody that's thinking the same as me, or I need to be challenged. Intellectual ability is one thing. Too much intellectual ability is not good as an investor. So you need people who are prepared to speak their mind, who are practical, who are objective, who are hungry for knowledge, hungry to succeed. That's one of the things that a lot of the people don't put in, the competitive nature. But then you need to subcategorize the competitive nature. Win at all costs, you don't want to hire that person. But you do want somebody who's really keen to win, or more importantly, not lose. So there's subcategories.
It seems to me that if you build a firm and a team of people with those sorts of attributes, you make yourself so much more resilient than you otherwise would be. It's a companion piece to having enough cash to cover 18 months or 3 years worth of costs. So something you've spoken about in the past, Dave, with great acuity, is the disruption that's underway in various industries such as healthcare and energy. In what ways do you foresee the investment industry being disrupted, and who's going to survive and thrive and who's not? Dave and I continued our fascinating conversation for another hour after this. So we'll pause it here and pick it up in the next episode of the Investment Community Podcast. I think you'll enjoy it. I know that I did. Thanks for listening. You can sign up for more of my podcasts as well as my newsletters at newdigate.substack.com. Until next time.